Hi everyone, so we're going to be going through the standardized workings for this consolidated CSoFP question, and for a change we're going to be using Excel to reflect the exam software, but I appreciate the exam software has limitations. So firstly, you need to make a note of your year end, that would help, and you need to know what who your parent is. The next thing is for the working one, we want to understand who our associates are and who our subsidiaries are. So we need to know percentage ownership, date of acquisition, retained earnings, and acquisition is quite a handy column to have in, consideration at acquisition, the type of consideration. So type of consideration at acquisition will feed into your Goodwill calculation. And type of acquisition, you might need to recognize an additional liability, or because, for example, if you have contingent consideration, that should reflect the fair value. Deferred consideration, deferred consideration should reflect the present value of discounted cash flows. And both of these are types of liability. Okay, next, just for this question, you don't have to do this, but for profit for B, which was acquired at the beginning of the year, I've put down the profit for the year, 15,000, just as a reference. Okay, firstly we need to understand the equity value of the subsidiaries and net assets. We need to know what they are at fair value. Okay, so just be clear, it's not the carrying amount, it's the fair value. And for this working, please don't factor in percentage ownership. And what I mean by that is we don't care if it's 80%. Okay? And B, and don't include associates, because associates we look at separately. So this is only to do with net assets, only to do with subsidiaries. Okay, so for subsidiaries we need to understand equity at the year end and acquisition. Make sure you include share capital, because that's part of equity, and include 100% of the share capital. So for the year end you can get the figures from the draft FS. Acquisition they'll tell you. Next we have is the retained earnings. So retained earnings, basically the way to think about this is that retained earnings is the accumulated profits over many years. So it's a measure of how rich people are getting, or how the business is performing over the long term. And as a group, we only care about the movements in retained earnings after acquisition, after the entity became part of the group. How did the entity perform after it was acquired? So this comes from the year end, from the FS, as I said before, and this will be told in the question. You then do your movements, your totals. You can do a total column here, you don't have to. Actually, the less total columns you have, the less likely you are to make mistakes. Now, I told you this before, but you need to make sure that your net assets are at fair value. So you might get cases where the fair value of the assets was greater than the carrying amount, so you need to make an adjustment. For example, the fair value was greater by 315k. So you need to make the adjustment both at the acquisition date and at the year end. Okay, so make sure you're adjusting at the right places and leave lots of room for your adjustments. Also, they might tell you, okay, useful life was this much. If they ever mention useful life, I always think of depreciation. They're trying to tell you something here. So even if your fair value is increasing, a downside is that you have depreciation, additional depreciation. Okay, so if you factor those in, you'll get your final figures, and the post-acquisition movement is the £9,000 in this case. and that's going to feed into your calculation of NCI and consolidated retained earnings. So NCI, you don't put this in your workings, but I'm just telling you. So if the ownership is ownership of A is 80%, NCI is getting 20%. So the remaining consolidated retained earnings are getting 100% minus the 20% times by the 9,000. Let me just get rid of that. So it's getting 80%. So from this, the NCI is getting 20% of the 9,000, which is 1,800. And the consolidated retained earnings is getting 7,200. And that works because the total is 9,000. Okay, I'm just going to clear that content, and we're going to move on to the next calculation. So these calculations are important because net assets at acquisition is going to feed into our goodwill, and the 9,000 is going to feed into consolidated retained earnings and NCI. Okay, so that's why we need this calculation. It helps us deal with multiple areas. Now, goodwill basically is where you pay more. It's the excess of the consideration, the amount you're paying, over the valuation of the portion of the company you've purchased. Okay, so the valuation of your portion, so proportionate method, you take away 100% of the net assets at acquisition, which is coming from the 6315, which I'll show you. So make sure, if you get this figure wrong, this figure will also be wrong, but that doesn't matter too much, as long as you put for as many adjustments as possible, and it's clear where you're getting the 6315 from. Next, you add on the portion of NCI. Now, for proportionate method, it's based on the portion of the total net assets. Okay, so in this case, NCI was 20%, so we do 20% of net assets at acquisition, which is 12,063. Now, this calculation works because what we're actually doing is we're starting off with 100,000, and we're taking away 80%, because minus 100 plus 20 gives us 80%. So we're taking away only our share of it, or the group's share. So then we have our goodwill, initial goodwill, but then we have current year impairment. Okay, we might have a current year impairment, so each year goodwill is assessed for impairment under IFRS. For FRS 102, you amortize the goodwill. You might also have some prior year impairments as well. So those also will feed into. You remember, I'm just going to add a negative. So these are reducing your goodwill, aren't they? And these are prior year impairments. And these might feed into I think these do feed into consolidated retained earnings. And I just want to be clear that for the proportionate method, 100% of the expense goes to consolidated retained earnings for proportionate method. Now, the next working we have is investment in associate. So remember, associates, no goodwill, no NCI, no working to. Now, let's see where the figures are coming from for the investment in associate. So we put in our consideration, which comes from working one, and I've already put it in there. Next we have is our share of profits. Now, put in the calculation you're actually doing, because that will get you at least half a mark. So share of profits was 30%. Our interest was 30%, as you saw in the group structure above. So you do 30% times by the profit. I'll show you where this is coming from. So our interest was 30%, we basically did 30% times by the 15,000. That gives 4,500. And this amount is going to go to consolidated retained earnings because it's a profit, consolidated retained earnings, okay? And we're going to allocate it to the parent company. Okay, it's not a subsidiary. We can't allocate it to subsidiary because it's not a subsidiary. And just to point out, impairment, I sometimes make the mistake of doing 30% of the impairment cost. Don't do this. It's 100%. Okay, so impairment is the write down of the investment in associate. Put in the full impairment, okay? It doesn't make sense to put in 30% of it. So impairment and share of profits are two separate things. Okay, don't confuse the two. We might have some further adjustments, but you will understand these when you do exam questions. So next we have our NCI at year end. So these are the minority shareholders of subsidiaries, and they're nothing to do with the parent company, okay? They own part of the subsidiaries. So NCI acquisition we start off with first, and where does that come from? That comes from our Goodwill working, which we've already done. Okay, so actually we're feeding in information we've already done to help us complete the question. Next we have is our share of post-acquisition returns from the subsidiary. And where's that coming from? This 1800. Well, we know that 20% of the NCI is 20%, and our post-acquisition movement was 9,000. So it's 20% of 9,000, which is 1,800. Okay, and then we might, if we're paying dividends to NCI, we take those away, and then we're left with NCI at year end. Okay, next we have consolidated retained earnings. So these are retained earnings associated with the owners of the parent company. So they're the other investor, other equity investor. Okay, so we put in the retained earnings of the parent at the year end. So parent's single financial statements. Now next we have the post-acquisition movements in the subsidiary. So we had an 80% shareholding in, so we can do 80% times by, I'll show you if I just go up. We can do 80% of the 9,000. Now let me just correct this calculation just very quickly. So remember, it's best to check that your workings are feeding through properly. Oh no, this is right, sorry. This is right. So, okay, let me just go down back to where I was before. So we can do 80% times by the total post-acquisition, or we've done the hard work in NCI, so all we can just do, we can do the 9,000, take away we can do 9,000 take away the 7,200. Okay, so we've got a post-acquisition movement. Next we have is the share of profit from associate. So this comes from our working in the associate. And that's coming from this 4,500. Next we might have additional you don't need this draft figure, by the way. I'm just doing it just for presentation purposes. but you know, you're probably going to have lots of adjustments because they love putting through adjustments. Nothing is ever straightforward. So you might have less impairment on goodwill. And I just want to point out, for the proportionate method, none of the loss is allocated to NCI. So the NCI isn't becoming poorer. Instead, the owners are becoming poorer. So all the £11,000, which came from working free, goes to retained earnings. Okay. Now, I just want to point out as well, we allocate this to the parent company because we can't allocate it to subsidiary. This is the parent's the one who's buying the subsidiary, so we allocate it to the parent. Okay, and I just want to point out the £11,000, you won't find that in the single financial statement. This is just arising as a result of the consolidation process. Okay. We can't, and then also you might have impairment of the investment in associate. That's going to go to consolidated retained earnings. Okay, that will go to consolidated retained earnings, which is here, £17,000. And this is an expense to do with the parent company, because that's the one that's because that is the one entity that is investing in the that's the entity that's investing in the investment in associate. And then that's basically it. So I think there are quite a few areas where you can make mistakes, but it's not about getting the 100%, it's just about doing enough. But I think if you play your cards right, you can get a lot of marks in this. But just try not to get confused. I think I sometimes get confused between the different accounts. In reality, in real life, to be honest, you don't normally do these. You won't use these kinds of workings because you'll often know what the consolidated retained earnings are at the beginning of the year. So you can start off with that figure already. Whereas here we're starting off from scratch. But it's quite fun to do actually, and I actually find it quite fun. Thanks everybody. Cheers. Bye.